Today we interview Todd Tresidder. He's the best-selling author and the hedge fund manager who retired at the age of 35 years old. He's been featured on NPR, Forbes, U.S. News, Investors Business Daily, the Huffington Post, the Wall Street Journal. And on today's show, he shares how he used the $100 strategy to land his early investors, how hedge funds actually work, and how much money do you need to retire. This man has a plan for everything you need to know to make your money grow. Without any further ado, it is my pleasure to introduce to you the man, the myth, the icon of investing, Todd Tresidder.
Get ready to enter the Thrive Time Show.
We started from the bottom, now we hit. We started from the bottom and we'll show you how to get here. Started from the bottom, now we hit. We started from the bottom, now we hit.
We started from the bottom, now we're on the top, teaching you the systems to get what we got. Cutting Dixon's on the hooks, I break down the books. Z's bringing some wisdom and the good looks. As the father of five, that's why I'm a dive. So if you see my wife and kids, please tell them hi. It's the C&Z up on your radio. And now 3, 2, 1, here we go.
We started from the bottom, now we hit. We started from the bottom and we'll show you.
Yes, and yes, Thrive Nation, we are in the air everywhere. And Z, normally on this show, we teach people super moves that they can use to start a business.
Oh, yeah.
To grow a
business.
business.
Oh, yeah.
To scale the business.
To not have to shut down the business.
You as the state's largest optometrist, the owner of the state's largest.
Hey, wait, I lost weight the other day. I don't think I'm.
As the thinnest owner of the largest optometry clinic by volume, and as an owner of a bank, and as an owner of an auto auction, you know a thing or two about growing a business, but yet you don't typically spend your time helping people retire.
No, I can't say that I do.
So on today's show, we've got an expert in this area.
Oh,
Todd
cool.
Tresidder, welcome on to the Thrive Time Show. How are you?
Great. Thanks for having me on the show.
Hey, Timothy Johnson, who's an ophthalmologist, told me to give you a big shout out. He told me to tell you hello. So hello on behalf of Timothy Johnson from Tuscaloosa, Alabama. Sir, I want to get right into it if we can. How much money do people actually need to retire?
It depends on how much you spend. In other words, your amount you need to retire is a multiple of how much you spend. So, again, a simple solution is the rule of 300, which is for every 1,000 that you spend per month, it takes about 300,000 in assets using traditional investment stuff. Now, there's more nuance to it than that. So you can, if you mix in real estate and business and things like that, but just in terms of a traditional portfolio, for about every 1,000 a month you spend, it takes anywhere from 300 to 400,000 in assets to support it.
Wow.
So let's say that somebody out there, I'm not trying to paint you into a corner. I'm just trying to make it simple for the listeners. Let's say if we have a listener out there, husband and wife, and Josh, tell me if this sounds reasonable. Between the husband and wife, they live on $10,000 a month. Between the husband and the wife, how much money, Todd, would somebody need to retire then? I'm just trying to help because some of our listeners are driving right now. They're kind of contemplating. How much money would they need?
Yes, the math works out to 3 to 4 million.
Okay. And so let's say they're listening right now and they are 40, 45 years old. They're in their 40s. How can you help them, sir?
You have to develop a plan to achieve your financial goals, right? And traditional financial planning comes up a bit short for most people, as indicated by how few people are actually prepared for retirement when they get there. And so what I do is I teach people non-traditional methods, more advanced methods. So, you've got the traditional financial planning advice, and then you've got the next level advice, which is what I provide.
For a guy like Timothy Johnson, he's an ophthalmologist. He's doing well. How could you help a guy like that? I mean, do you sit down with somebody and make a customized plan? Is it like a coaching service? I mean, how does that work?
Well, I have books and I have courses. Right. So I'm trying to get this out to more people, trying to get the information out to more people. I used to coach people one-on-one. And so using your example of Timothy, an ophthalmologist, often what will happen is a highly paid professional, which an ophthalmologist would fall into, or an optometrist would fall into if he has a thriving practice. Usually the strategy would be that they would maximize their practice. They try to get their wealth translation, which is how well they translate the income from their practice into their personal assets. Most people are very ineffective at that. So you have to get that translation equation working. And then you also you'll generally buy the property that your business is housed in is a very common strategy in that situation. Most accountants worth their salt will show you that if you're going to be in business for 15 years plus, that it almost always makes sense to own the building that your practice is in. And so usually the combination between translating the income earnings from your practice combined with paying off the property and having that as a rental property, plus you can sell your practice at the end as an optometrist, usually those three things are more than sufficient to achieve your financial goals.
You help people achieve a high net worth, but yet I understand that you grew up with a low self-worth. And again, Z, if I'm saying something that's not true about a guest, I'm just going to pre-boo myself.
Just do it. Yeah.
Because you never want to say that on somebody. You never want to say that somebody grew up with low self-worth and then be wrong about it. But
correct.
Todd, would you agree with that description that you kind of grew up with some low self-worth?
Yeah, it's out of context and it sounds worse than it is.
Good thing you booed yourself.
I was ready.
What I explained to people was that a lot of people, they try to achieve financial independence. They confuse self-worth with net worth.
Got it.
And what I learned in the process, so I achieved financial independence at a young age, and yet I was still the same miserable person looking back at me in the mirror. And that's when I had to go on a personal development journey and understand what really brings fulfillment. That's one of the unique things about my teachings is how it combines fulfillment with financial independence. It's not just about the money. Because the usual situation is that people don't try to achieve financial independence because they want more money. Nobody really wants more money. What they want is what they think money will buy them. And so that sounds like a nuanced difference, but it's actually a profound difference. And so I found that most people who pursue financial independence are often acting out from a low self-worth. And so we try to overcome that right from the get-go so that as they achieve their financial goals, they also achieve their fulfillment goals. Mm.
At the age of 35, I believe that's when you were, quote unquote, retired. Do you have any, can you maybe share with us how you were able to achieve financial success so quickly?
Yeah, it wasn't hard for my situation. So I was one of the early pioneers in the hedge fund industry. So I developed a successful business and had a very lucrative income. And yet I maintained kind of a college kid lifestyle. I never really expanded my lifestyle. The things I enjoy are outdoor recreation, books, things like that. They just don't cost a lot of money. I've never been a very lavish spender. I'm not cheap either. I live in a nice home in a nice neighborhood, very middle-class lifestyle. But I never really jumped the lifestyle. And so the spread between my rapidly growing income, very high income, and my very moderate lifestyle created a large savings rate. And so the math on retirement planning is very clear. At the early stages, the most important thing you can do is have a large savings rate, a very high savings rate as a percent of your income. It's only in the later stages, once you acquire wealth, that your return on investment minus inflation becomes your key ratio. And so I just happened to get it right. And I got a very high savings rate off a very high income and saved a large amount of money, and then developed investment skills through developing the hedge fund. And that gave me my ROA minus inflation, my return on investment minus inflation equation. And so I was able to retire at a very young age.
You know, pretty soon, smart people shall begin asking you questions. We have two more to suffer through from me. And then I go to Dr. Zellner, then we'll move to Josh Wilson, and we have an attorney named James from New York here. So my final two questions for you. For the listeners out there that don't know what a hedge fund is, I think people know the word, the phrase, they can say it. Maybe they go, oh, hedge fund. Yeah, hedge fund.
I got to trim the hedges.
Yeah. But I don't think people know what it is. Can you explain on maybe a third grade level so that I could grasp it? What exactly is a hedge fund?
It's skill-based investing where the return comes from the skill of the management team and the decisions made. It's not passive investing where the return comes from the market return. So most people, their investment strategy is passive, where they're dependent upon the rising market to make money. And when the market tanks, then of course they lose money. With hedge fund investing, you can make money or lose money in any market environment. It's a function of the skill of the management team.
That makes sense to me. So you are, as the leader of the hedge fund, you had to know what was going on and make key decisions, as opposed to just passively spreading out your money with something like a mutual fund, where if the economy goes up, everybody goes up. It goes down, it goes down. Is that accurate, sir?
Yeah, that's accurate. Actually, just to even be more detailed about it, I was one of the early pioneers of what's called quantitative investing. So I had this crazy idea when I was in college. I was in an investments course, and they had all these pretty charts of stocks and commodities and things. And I walked up to my investments professor and I said, well, I can make money off that mathematically. I don't have to know anything about it. It's just a wiggly line. I can extract profits from statistics and math. And he said, that's impossible. Well, I went on to do it. Again, I was one of the early pioneers of quantitative investing and quantitative risk management in the hedge fund industry.
Todd, how did you get because I mean, it wasn't just all your money, right? And that's one of the things. You get people to come on board and believe in you. How'd you get your first 10 guys to put money in your hedge fund?
That's a good question.
One of the partners in the hedge fund was a former life insurance salesman. And so we were marketing to small companies that had large pension accounts, but they were too small to attract the big name managers.
Gotcha.
And so we had a thing called the $100 bill strategy. We would mail out a crisp, brand new $100 bill, all we asked for was a 15-minute pitch. And they thought it was so clever. Back then, it was clever. Because back then $100 meant something, and so it was clever on two levels. One, it got the door open and passed all the secretaries and everything, because the secretary couldn't keep it; it could get in trouble, so they had to pass it through the boss. The boss couldn't keep it because he's a fiduciary for the retirement plan, and we knew it, and they knew it, and they knew we knew it, and so it was just this really clever strategy. It worked. We got almost all the $100 bills back, and we got almost all our appointments. And then we actually delivered on what we promised. We said we knew how to manage risk. We knew how to develop consistent returns. They followed us for a period of time, and eventually we sold out the business.
The issue that I have, Z, with Todd here,
is he didn't get $100?
No, he comes across as extremely smart.
Yeah.
And it's intimidating. You know what I mean?
How'd you get him on the show?
Timothy Johnson says you need to book one of my idols, like, of investing, Todd Tresidder. And I say, you know what? I'm not that smart. We have lots of listeners, millions of listeners.
But did you say to him $100? Is that what you did?
I didn't. I'm just saying this guy. It's profound what is going down right now. I know somebody's going to want to read your book or get some more information here. Can we talk about the leverage equation and maybe what kind of person would want to read that book?
Yeah, leverage equation is really great for entrepreneurs. I have to reposition that book. It's one of my favorite books, but it's not the most popular. It's probably the second most popular. And it's really great for entrepreneurs to understand how to get more of their life back and grow their business. And it sounds cheesy, grow your business by working less, right? But it's through leverage. And it's not leverage like everybody thinks of. Everybody thinks of leverage as just like financial leverage, like mortgage and debt and things like that. This is about 6 types of leverage, and only one increases your risk, which is financial leverage. The other 5, you can actually increase return and reduce risk, and the book shows you how. And then the other book, the one that's my bestseller, is the book, How Much Money Do I Need to Retire? That book, literally, when it came out, it recreated retirement planning, because retirement planning as traditionally practiced, still to this day, is not correct. And that book is basically, it's a revolution. It goes through and shows you why most of the traditional approaches, including Monte Carlo calculators, which is currently the industry standard, are just wrong. They're dangerously wrong.
Wow.
And the book gives you very simple solutions, explains why why what works is different, and gives you 3 models and how to apply the 3 models. And it's just very clearly laid out, and the reviews speak for themselves.
I can see why it's the bestseller.
That's cool. Now, Todd's been featured in NPR, Forbes, U.S. News, Investors Business Daily, the Huffington Post, the Wall Street Journal. He deserves good questions now. And so now I get out of the way, and I open it up for you to be asked the first and really intelligent question beyond the one that you already asked. But you can begin to ask some really good questions now.
Well, we're so glad you came out of retirement, by the way, because it seems like you're writing and doing some stuff, and you have a cool website. So what are you doing right now other than writing? And it sounds like you came out of retirement, and why?
Well, I think retirement's a misnomer. People think of retirement as, you sit in a hammock on a tropical beach with an umbrella drink in your hand. And that's satisfying
for a few days, right?
Yeah, it's satisfying for a few months. Depends on the person. It might be a few weeks. It might be a few years. But ultimately, it's a pretty boring life when the only thing you're interested in doing is entertaining yourself. I know that's hard to understand from somebody that's working way too hard and is stuck in a career or job they hate. But ultimately, a fulfilling life is about owning your creativity and creating what's in alignment with your values. Life is meant to be used, and work is a good thing. Vacations are great too. I vacation 3-4 months out of the year. Usually I probably average about 3 months a year of vacation, except for with the COVID-19 right now. And so, but it's meaningful when it's in the context, it's enjoyable when it's in the context of meaningful work. And so Financial Mentor is meaningful work to me. I'm giving back the knowledge I spent, a lifetime creating and learning and developing, and I'm putting it in usable form in the form of products, of books and courses, to make it accessible to people at a reasonable price point. So that's sort of my passion project, as the kind of last thing I'll do with my life.
Josh Wilson, you have a company called Living Water Irrigation. The company's doing well. Perhaps you have an interest in planning for your financial future.
Yes.
I know that's something that's a hot topic for you from time to time. What questions would you have for Todd Tresidder?
So, Todd, my question would be, I think for a lot of listeners, and my wife has done a good job for doing this for us, but a lot of guys, late 30s, early 40s, I'm sure you hear this all the time, they start to achieve some financial success, but have no thought to their 60s, no thought to their future. What is a simple way to start? I think a lot of people feel it's too daunting or too difficult. Where would you start to begin to plan for that? I know you gave us some numbers on how much you need to retire, which seems, oh my gosh, I need 3 or 4 million. So what's the easy way to start to get there, Todd?
Okay, when you say, so you mean get there. What is
right.
there? Get to retirement? Get prepared for your 60s?
Get prepared for the retirement, to have the funds necessary to retire, Todd. Sorry, I didn't mean to make that so wordy.
So how do you amass enough capital to be financially independent?
Yes.
Essentially what you're asking.
Absolutely.
It depends on this. I'm an economist, right? It depends. It depends on. There's three asset classes you can use to build wealth. You've got business asset class, which it sounds like you have.
Yes.
You've got real estate asset class, direct ownership of real estate, and you've got paper assets, which is your traditional stuff you get that your stockbroker can sell you. Stocks, bonds, mutual funds, ETFs. Each asset class has unique characteristics, and so you've got them. The way it's done properly, and this is what I teach in my wealth planning course, you have to match the unique characteristics of each asset class to the unique characteristics of your life. So there's not a generic one-size-fits-all plan.
Okay.
And that's why it's so different from how it's taught at the financial planners' offices, where they're just selling you stocks, bonds, mutual funds, and there is a generic plan. That's what they're doing. They're giving you a generic plan. The way it works in practice, though, is there's 3 asset classes. People have unique life situations. You come with different resources, different skills. And so there's a process you go through to match those assets and the strategies you employ to your life situation to get the goals you want. The other thing I want to clarify in here is the reason I kept re-clarifying your question is partially to make a point, which is retirement is just a euphemism for financial independence. And you can have financial independence at any age.
That's awesome.
And so what you really want to do is think about when you want to be financially independent, by what age, and how are you going to get there, what assets you're going to use, and build a plan accordingly. So did that answer your question?
Oh, that was perfect, Todd. Thank you so much. Thank you.
Now, Todd, we have an attorney here from New York who is, whenever you bring a new guest into the studio,
Yes.
you don't want to underhype them.
No.
And
No.
and a lot of people really do love attorneys. And so you and I have been working on, this is a new theme song.
We got a new one.
It's the new one right now. See, this is the attorney, James. His claim to fame is he just moved here from Manhattan.
Oh, yeah.
See, here he comes. Here we go. The man, the myth, the
intro
attorney,
song. There we
James.
go.
Yeah, James. Welcome on to the show. What questions do you have here for the financial advisor, Todd?
All right. Great to be here, Clay, Z, Josh. Todd, nice to meet you.
Whoa.
My name is
Yo.
James. All right, here we go.
Did you come sliding in with your Michael Jackson moves?
Yeah, and platform shoes. You should see it. And a bandana.
And he only has one glove on, which is, I think, against COVID rules. We got to call the CDC, but he's got one glittery glove on. So
And no pants.
and no.
Whoa. And there's a bunch of men in the room.
Sorry. Hate to be accurate.
Okay, so I have a friend of mine who, when he was 13 years old, his grandfather gave him $500. And over the course of the following years, he turned it into over $1 million by investing in the market. And
How many years?
I met him when he was 26 or 25, so 10, 12 years, something like that. And
So he turned $500 into $1 million in 13 years.
Yeah.
Is your friend a Ponzi schemer?
Nope.
Does he know two friends?
Using what strategies?
What I wanted to say was I am the exact opposite of that, and I have no clue about the market at all. Or
James
really
just sues
investing or
people
anything like
for even
that.
asking questions.
I like investing in myself, and the question I have is the reason why I said that is because he's telling me that the market's on fire right now. It's going crazy. It's doing really well. It's skyrocketing
Right now, as of August 11th, 2020.
That's what I'm
Okay.
told. I don't know if that's accurate or not, and if it is
You're
accurate,
going to ask Todd, okay.
and if it is accurate, how can there seems to me to be a big disconnect between what I'm seeing on the ground, because before I came to Tulsa, I was in New York, and businesses were shuttering. The New York Post published an article in late July that said about a third of New York City's small businesses may never come back, and New York City has 230,000 small businesses, so we're talking about 70,000 small businesses closing. And as you know, they're the largest employer or a very substantial employer throughout the country, and that applies to New York City as well. And then, the trickle effect. Okay, if people can't work, they can't pay their rent, they can't. I saw an article a couple days ago.
So what is your question, though?
That said about a third or a quarter of people aren't paying rent. So how can the market be, if that's accurate, that the market is, cranking right now, how can that happen when retailers, small mom and pop stores are just tanking? How does that make sense?
Asset inflation. So the federal government during, the March-April period when COVID hit, the federal government released $2-3 trillion of aid in various forms, and then they increased their balance sheet by about $6 trillion through the Fed, and so all that money flows somewhere, and so it creates inflation. When the Fed prints money, it creates inflation, and it's going to create inflation in one of two forms. It's either going to be consumer price inflation, which you're seeing some of that in basics like eggs, milk, etc., but primarily you're seeing it in asset prices. So it's going in assets, so you're creating asset inflation. So your observation that there's a disconnect between Wall Street and Main Street is absolutely correct. But to say it's not logical is not correct. What's happening is the Fed pumped a bunch of money in the system, and the money found its way to the asset price.
What are the asset prices that you're talking about, like houses, or
stocks and
cars,
bonds?
or
Stocks. Yeah.
Everything. Well,
Yeah.
that's part of the way you can tell what's going on is when everything correlates one direction, right? Correlates means moves in the same direction at the same time. So if you notice in recent months, since the bottom in March, you have all asset prices moving in one direction, whether it's gold, bonds, stocks, international, domestic, housing, everything moved up all together at one time. That's because a bunch of money's chasing the same goods, in this case, asset prices.
Right.
Todd, I have two final
That
questions.
doesn't mean, by the way, I want to be clear, though. That's a speculation. That's not investing. And so that could turn on a dime literally today, tomorrow, any day, okay? It's a purely speculative market right now. It is not grounded in economic fundamentals.
Amen.
So this market is fundamentally different from other market conditions historically in that it's a purely speculative market, purely driven by government policy right now.
Wow.
Now I'm gonna Todd. I hate to do this to you. I mean, I love doing it, but I hate to do it to.
No, don't do it.
I'm gonna ask Todd. It's a question. It's one of those like double speak questions where no matter how you answer it, it couldn't be right. It's one of those political paint you into a corner. What is your favorite old school song? I mean, we know you know a lot about business. You're an investment mind, but I mean, at the end of the day, it all comes down to what's your favorite.
You're laying on the hammock. You got your cold beverage in your hand.
Something you might have enjoyed in high school. What was the jam for you?
AC/DC.
Whoa.
Like kind of like a TNT?
Yeah, the old stuff with Bon Scott, not the stuff with Brian Johnson, but the old stuff.
Wow.
Oh yeah!
Nice.
Oh,
There
wow!
we go.
He gets a mega point. And we don't give out mega points just to anybody.
No.
And they are redeemable,
It
Todd.
would inflate the value of it. It would,
Right.
If
we give too many,
it could
then
ruin our
inflation
currency if we
would-
just start giving
right.
them out. We only gave the co-founder of Netflix 3 mega points,
That's all.
and he was asking for more.
He begging.
But we said no. We can't
no.
ruin our currency.
We can't.
No.
No.
Todd, you can use mega points wherever you want, wherever they're
Redeemed.
redeemable. A lot of
And that's most
I'll exchange,
everywhere.
I'll exchange them for Bitcoin.
Blockbuster. Blockbuster.
No, seriously, Todd, that's a great question right now. Let's talk about cryptocurrency real quickly. And I know our time's
Pretty
wrapping
cryptic
up.
of you, Zeke.
I know it is.
Okay.
which one should we do? Should we do it at all? What's going on with that? And if I had a chunk of money, if I had a chunk of money in my little palms, and I called you up and said, Todd, and you said, hey Z,
Hey Tom.
hey Z, and I said, what is the best place to put it right now? Give me the biggest bang on my dollar, in your opinion.
It's not a fair question.
Oh,
are you asking about cryptocurrency or you're asking about all assets?
Oh, there. Well, let's do cryptocurrency first. Which is your favorite cryptocurrency?
All right, well, let's talk about cryptocurrency. I'm not going to sit there and give an investment recommendation on the air.
Okay.
It's not fair to people because you'd have to know the reasons I would like it, and you'd have to know the reasons I would exit. I could exit as early as tomorrow.
Sure.
And so somebody gets the recommendation by the time this airs. It's just not fair to them.
Okay,
so let's
enough.
talk about cryptocurrency instead, because that's a more interesting conversation, actually, in that, the future absolutely is digital finance. Okay, so cryptocurrency, the pundits of cryptocurrency got that part right. And the future is blockchain connected to digital finance. So they've got the core tenets right. But there's a piece in the whole discussion of cryptocurrency that I see almost never addressed, or if it is addressed, it's addressed only casually. And to me, I think it's a deal breaker, and that is there's no historical precedent of a government allowing a competing currency against its own domestic currency. It gives up too much control of government policy. I think it's interesting that government has given no official verdict on any cryptocurrencies whatsoever. There's no official sanction, agreement, anything on it. There's absolutely zero. And there's a reason for that. They're just waiting. And so the problem with cryptocurrency right now is that ultimately it will likely get replaced with some government form, either internationally or domestically. So it's kind of like the internet in the early days, right? The internet fulfilled its promise, but a lot of the early .com stocks all went to zero. And that's because they got some of the basics ideas right, but ultimately they were replaced by the true leaders that took over. And I think the same thing's going to happen with crypto. I think ultimately it will fulfill its promise, but I have no reason to believe that. Let me put it this way. If the government can steal trillions of dollars with government edict and there's no political downfall to it, then they're going to do it. And so it's only a question of time until they outlaw crypto, in my mind, and replace it with their own domestic electronic currency, the e-dollar or whatever they call it, the e-dinero or whatever its name becomes. And that could exist at the IMF level internationally. It could exist domestically, but I think that I think crypto again is just a mass speculation where the Bitcoin could go to 1 million and it could go to zero. And in a world like that, I choose not to play.
Sure.
I'm an investor. I'm not a pure speculator.
Yeah.
Wow.
Well said.
So anyway,
Awesome.
So my point is that they're missing a key risk function in almost all the discussions on crypto. That you'll hear the same stories repeated over and over again. People are super excited about crypto for good reason. It's an amazing revolution, digital currency and all that. But they're just missing a key aspect of the equation. It's usually the thing you don't look at as the thing that blindsides you.
Interesting.
Todd, I'm going to have to listen to this show twice and almost slow-mo it. Would you agree, Josh? Would you have to?
I'll have to listen to it 3 times.
And this is why he's an author too, because you can go read his books. Todd, for the folks out there that want to learn more about you, what's the best place for them to do that, or what's maybe the book that you'd recommend our listeners who are just beginning the Todd Tresidder conversation? What's the book they should be checking out?
Yeah, so my website is financialmentor.com, 2 words mashed together, financialmentor.com. And I've got 1,000 printed pages of content for free. Come over there and get the free stuff. I've got one of the largest collections of financial calculators on the internet, free. Again, it's, wealth is math, and so you've got to understand that, and so this does the math for you. So all that stuff's for free. I give away a free book on my site for people who want to subscribe, and I've got a free mini course on the site. So there's all kinds of ways that you can build a relationship and start to decide if the message resonates with you or not. And for those that want to take the next step, I've got 6 books. The 7th one is in the works. And my master course is Expectancy Wealth Planning, and it's Advanced Wealth Planning. And so basically my core message is that I just take the stuff to the next level. It's just advanced stuff. It's for people who have been there, done that with traditional financial planning. They're ready for something more accurate and complete.
Financialmentor.com, is that the website you recommend everybody checks out? Financialmentor.com?
That's the hub of everything I do, financialmentor.com.
So do you have like a double platinum class where I can actually like come and hang out in your hammock in your backyard? Is that a move or not?
That's the Expectancy Wealth Planning course.
Oh, well, there you
go.
There you go.
Nice.
I knew it.
Todd, thank you so much for being here, my friend, and I hope you have a great rest of your day.
All right. Thank you for having me on the show. I appreciate it. It was fun talking with you guys.
And now, without any further ado, 3, 2, 1.